Ever wondered how investing works? Well, it's not as complicated as you might think. Investing, in a nutshell, is about making your money work for you. It's like a magic trick, where your money multiplies without you having to lift a finger. But how does this magic happen? Imagine you're planting a seed. You water it, give it sunlight, and over time, it grows into a sturdy tree. Similarly, when you invest, you're planting your money in different financial schemes, shares, or property. You nurture it with patience and smart decisions, and over time, it grows. But instead of bearing fruits, it brings you profits. Sounds exciting, right? But remember, just like gardening, investing requires knowledge, patience, and a bit of risk-taking. So, are you ready to plant your money tree? Investing is like planting a seed and watching it grow into a tree. Now, let's dive into the types of investments: stocks, bonds, and mutual funds. Imagine owning a piece of a company you love. That's what stocks are all about. When you buy a stock, you're essentially buying a tiny slice of a company. Think of it like a pizza. The company is the whole pizza and each stock is a slice. The more slices you own, the bigger your piece of the pie. The profit you make from stocks comes directly from the company's success. If the company does well, the value of your stock slice increases. It's like if your pizza slice suddenly became bigger because the pizza got bigger. But just as it can grow, it can also shrink. If the company performs poorly, the value of your stock decreases. Your pizza slice just got smaller. So, investing in stocks is a bit like a roller coaster ride, thrilling but risky. But what if you want something a little less risky? If stocks are like a roller coaster, bonds are more like a steady train ride. Imagine this: when you buy a bond, you're essentially playing the role of a bank. You're lending your hard-earned money to a company or even the government. But why would you do this? Well, the borrower, whether it's a corporation or Uncle Sam, agrees to pay you some interest on your loan at regular intervals. Now that's some steady income, and it doesn't stop there. After a certain period, known as the bond's maturity, they'll pay back the amount you lent them. That's your principal back in your pocket, along with the interest you've earned along the way. It's like a long-term savings plan with a bit of extra oomph. So bonds provide stability and regular income, making them generally considered safer than stocks. But here's a question for you. What if you want a mix of both? Mutual funds, the best of both worlds. Just as the name suggests, these investment vehicles are all about synergy, about bringing together the strengths of different types of investments. They're like a smorgasbord of financial opportunities, with a little bit of everything mixed in. Mutual funds allow you to invest in a diversified portfolio of stocks, bonds, and other securities. That means, instead of purchasing a single stock or bond, you are buying a piece of a large, diverse portfolio. This variety helps to spread out the risk. It's akin to having a team of superheroes, each with their own unique powers, working for you. If one falls, the others can still save the day. This diversification is vital. It's like going to a buffet. You wouldn't just pile on the mashed potatoes, would you? Of course not. You'd take a little bit of everything to balance out your plate. Similarly, mutual funds help balance out your investments. Mutual funds offer diversification, which is like not putting all your eggs in one basket. You're spreading out your investments, enhancing your chances of success while mitigating potential losses. It's a savvy move for any investor, from the newbie to the seasoned pro. So, we've learned about stocks, bonds, and mutual funds, but which one should you choose? That's entirely up to you, and depends on your own financial goals, risk tolerance, and investment timeline. Let's recap quickly. Stocks offer ownership in a company and the potential for high returns, but they also come with a higher risk. Bonds, on the other hand, are like loans you give to a company or government, promising lower returns but with less risk. And then we have mutual funds, a sort of middle ground where you pool your money with other investors to buy a diverse mix of stocks and bonds, spreading out the risk and potential returns. Remember, there's no one-size-fits-all solution in investing. It's all about finding the right balance for you. Remember, investing is not about getting rich quick, but about growing your wealth steadily over time. Stay tuned for more investing tips and strategies.